Only one financial vehicle allows you to accumulate, access, and transfer your money tax-free. And when you transfer it, it blossoms, it increases in value. I'll explain that next because I'm going to answer the question, why is a max-funded IUL tax-free during accumulation, distribution, and transfer? This is going to blow you away. By the end of this video, you will understand how a max-funded IUL allows accumulation, access, and transfer totally income tax-free and how it blossoms. So I'm Doug Andrew. I've been a financial strategist. I actually began in 1974. So my story begins clear back in 1974. I'm an old geezer. I mean, I might have an Apple Watch today, but my first watch was a sundial. I'm that old. So what happened in 1974? Actually, I was going to go through law school to become an attorney. And as a means to that end, I got my Series 1 securities license. They don't offer those anymore, but it allowed me to sell any stock, bond, mutual fund, or whatever. And I got my insurance license. And to work my way through college, I was going out helping people optimize their assets by purchasing insurance and investing money. It was like buy term, invest the difference, but it was sort of forced where they could put money into this instrument. It was called the investor, and 1/3 would go towards insurance to protect them in case they had a premature death, because you want to be responsible and accountable if you die and you leave behind a spouse and children that we're going to rely on your financial wherewithal to continue to grow and be able to take care of themselves, okay? So responsible people would insure themselves with life insurance. But rather than use permanent insurance, whole life at the time, it wasn't usually a very good rate of return, so we would invest the difference in a mutual fund or mutual funds of their choice. And so I went out, and by 1980, I was responsible for over 3,000 clients in 13 Western states. And then what happened? Huge epiphany, and we credit this to E.F. Hutton. E.F. Hutton wasn't an insurance company. They were a brokerage firm. And they realized that having their clients put money in the stock market oftentimes I describe as a person with a yo-yo, hopefully walking up some stairs. And what I mean by that is that the market goes up and down and up and down. That's the yo-yo. But walking upstairs means you hope that the market will be worth more, the stocks or whatever down the road. The S&P, the Dow Jones, the Russell 2000, these are measurements of how the market's doing, are going to be higher down the road when you are going to use the money the most in retirement or whatever, okay? There are periods of time like the Great Recession, the year 2000 to 2012. That person with a yo-yo was walking across a flat surface, so to speak, meaning the Dow Jones, the S&P, the Russell 2000 were basically back to where they were in the year 2000 in 2012. In the meantime, it went down twice, 40%. And so people that started out with $1 million in the year 2000 barely had their $1 million back in 2012. And that was pretty pathetic. People using indexed universal life actually ended up doubling or tripling their money. $1 million was worth $2 or $3 million at the end of 2012. And so that is really what happened. In 1980, E.F. Hutton said, why don't we use the multi-trillion-dollar insurance industry, the backbone of America. They manage trillions. In fact, some companies manage as much money as the IRS collects in taxes in an entire year. They're huge. This is where governments go to sometimes for help. And so Hutton said, why don't we put our money there, and we may not get as big of returns when the market's going crazy, at 20% maybe, but not lose when the market goes down because your money is not in the market. You're getting the interest credited from the insurance company. Now, that was universal life, and from 1980 to 1990, I never earned less than 11.75%. I earned as high as 15.5%. Well, what happened in 1997, this was when indexed universal life came out because interest rates started to come down. And in order to help people benefit when the market was doing well, but not lose when the market went down, is to not put your money in the market. That's like variable life. You want to still keep it out of the market, but allow the insurance company to pay you whatever the market is doing if it makes money, but not lose when the market goes down. And it's actually pretty simple. It's called indexing. On $1 million nest egg, if you, in an insurance company, let's say, I don't care if it's 10,000 or 100,000, you're saying, you know what, you're earning on that money, that's called their general account portfolio, 5%. Now, they need one of those percentage points for them. Okay, they're in business to make a profit. So let's say it's a net of 4%. You're just saying, you can pay me 4% if you just want to play it safe, or you can go, you know what, don't risk my million, but take the 4% on my million that you're earning this year, 40,000, and you can finance an options budget, which simply means the insurance company buys upside options in the S&P, the Dow Jones, whatever index you choose that they offer. Then those options double, triple in value, and they can pay you 8%, 12%, or whatever based upon their options budget. Now, if the market loses, you don't lose your million. Your million's not in the market. Only the interest on your million basically was tied to an option. And so this is absolutely incredible. That's called indexing. So the point I want to make is we can accumulate our money totally tax-free inside of one of these max-funded universal life insurance policies, and I would recommend indexed universal life because I've earned 9.62% average ever since the emergence of indexed universal life in 1997. But some years, my heavens, our clients have earned 61%, like in 2021, and some people even credited 153% tax-free. But if the next year the market crashes, they don't lose a dime of what they made the year before. The three sections of the code that I'm talking about that E.F. Hutton realized in the current code are sections 101A, 72E, and 7702. In a nutshell, these basically mean this. Money inside of a life insurance contract accumulates tax-free under section 72E. All the interest and dividends, you do not have to pay tax on it, okay? 7702 says if you want to access money out while you're alive, you can do that totally income tax-free if you adhere to 7702. And then when you ultimately die, anything left in there, if you have, 500,000 left in there, it would blossom maybe to $1 million. I'm 70. If I got killed in an accident tomorrow, every $1 million I might have in indexed universal life would blossom to $2.5 million and transfer income tax-free. That's section 101A. So people go, wow. Yeah, nothing else competes with this that I'm aware of in the Internal Revenue Code. When this came out in 1980, E.F. Hutton was going gangbusters, and the IRS came in and said, what are you doing? And they said, we're not doing anything wrong. And they went to court. E.F. Hutton won. But then the IRS went to Congress and said, we got to change the definition of tax-free accumulation, access, and transferability inside of a life insurance policy. Under these three sections of the code, we think you're overstepping your bounds. And so in a nutshell, in 1982, under the Tax Equity Fiscal Responsibility Act, it spells the acronym TEFRA. They didn't know what they were doing, and so they had to redefine it again 2 years later, 1984, under the Deficit Reduction Act. Basically, TEFRA and DEFRA is what it's called, dictates the minimum amount of life insurance that you must have on your insurance contract in order for it to adhere to being tax-free under the definition of tax-free insurance. If you do not do that, if you try to put in $1 million into a dinky little $10,000 life insurance policy, then the IRS will say that's an investment and you have to pay tax on it one way or another over here in a different section of the code. And so you want to stay under this tax-free definition here. And so that means that however old you are and your health, you have to have a certain amount of insurance, but TEFRA and DEFRA actually gave parity, meaning equality. So it doesn't matter if you're a 22-year-old athletic marathon running female or a 60-year-old or a 78-year-old friend of our family. When he came to us, he had adult onset diabetes, a prostate cancer episode, 3 blocked arteries, and he had 6 sisters predeceased him and 3 brothers, but he was actually able to pass the insurance exams. And but he was able to get an insurance policy, and his rate of return was the same as the 22-year-old athletic marathon running female. The amount of insurance required for him, because he was older and unhealthy, was way less than the 20-year-old had to have under TEFRA and DEFRA. What it means is if you're going to use a max-funded insurance contract more for living benefits, you can squeeze down the death benefit. If the 23-year-old earns 11, they net 10, and the 78-year-old with one foot in the grave, so to speak, can earn 11 and net 10. You wouldn't believe how many financial advisors don't understand what I just said. Now, before I explain TAMRA, I just want to encourage you, if you can think of somebody who ought to watch this, or you want to post a comment, be sure and do that, click like. But I want you to subscribe. It's free. Just subscribe and click that little bell, because then you'll be notified every time I post a new episode, which I do almost on a daily basis. But I want you to stay to the end, because I want to gift you a 300-page, $20 book for free, okay? TAMRA happened in 1988. That stands for the Technical and Miscellaneous Revenue Act of 1988. There was this massive exodus of money leaving the banks, the brokerage firms, and the credit unions, going over to these because they were safer, they paid higher interest, it was tax-free, and they blossomed when you died, when they were transferred to your heirs. Nothing else did that. But see, the banks and the brokerage firms, they didn't want to kill these, because this is where they put about 30 to 40% of their tier 1 assets for liquidity and safety. A lot of people don't know that. And you put your money in a bank, and a bank turns around and puts some of your money right into an insurance company earning 5, and they only pay you 1. They're making 5 times what they're paying you. So TAMRA basically said you got to slow the flow. So these have to do with the minimum amount of insurance, and TAMRA has to do with how fast you can fund it. So after June 21st of 1988, what happened, if I compare this metaphorically to a bucket, the bucket is the IUL, the insurance policy. This represents the amount of money you can put in. TEFRA and DEFRA and TAMRA come into play, where if I'm a 60-year-old male, for example, and I want to put in $500,000 into this policy during my lifetime, the minimum amount of insurance is $1,250,000, approximately, okay? About 2.5 times that. Now, I can buy way more insurance than that for $500,000. That's not the objective. You want the least amount of insurance so that the spigot on the bucket, which is the cost of the insurance the IRS says has to be there or it's not going to be tax-free under that protected part of the code, is actually watering a money tree that's going to blossom this to this or increase the payout. But see, what happens is you don't have to put in $500. It would behoove you to. Back in 1980, you could throw that in one fell swoop. But after 1988, they said, oh, no, the most you can put in is about a fifth. This is for somebody over age 50. And so you put in 100,000 and then another 100 on the first day of the second year. But it takes you 4 years and 1 day to get in the 500,000 if you wanted to get it in as fast as you can. Then you've complied with TAMRA. If you threw in all the money in one fell swoop, it only grows tax deferred. And then when you start taking money out while you're alive, it's now taxable. People want tax-free, so they comply with TAMRA. So this is the way that you accumulate, access, and transfer your money tax-free, because whatever's in here will blossom. If you put in the first 100,000 and you happen to die, they're going to pay out $1,250,000. But this 500,000, based upon actual history, will double to $1 million in 7.5 years, and then $1 million will double to $2 million in another 7.5 years. So in 15 years, this is now worth $2 million, and the death benefit was only $1,250,000. The actual cost of the insurance, it's 1/20th what it was 15 years earlier. The cost of insurance gets cheaper as you get older. Now, if that doesn't blow you away, you need to search this channel to find out, how can I have an insurance policy that gets cheaper as I get older? If you haven't seen one, you have not understood how to structure it correctly, and a lot of financial advisors, unfortunately, don't know how to do this. When you start taking money out, you want to make sure that it's tax-free, and there's only 3 types of income Americans pay income tax on in America: earned income, passive income, and portfolio income, ever since 1986 tax reform. So when people have $1 million nest egg and they're earning, 9.6%, they can pull out $96,000 a year. That's $8,000 a month. It's totally tax-free. And it's not deemed earned, passive, or portfolio income. The IRS knows they're receiving it, but it's tax-free. It is that cut and dried. So if you want to learn more, let me show you how you can claim your free copy. So, free copy of what? My most recent best-selling book. This is book number 11, called The Laser Fund. LASER is an acronym that stands for Liquid Assets Safely Earning Returns. What is a laser fund? It is a properly structured, maximum funded, indexed universal life policy. I would say that 99% of IUL policies would not be able to be called a laser fund because they're not structured correctly or funded properly. So I want to gift you this book. It's actually 2 books in one. This side is 200 pages, all the charts and graphs and explanations for the left brain thinker. You flip it over to this side, and this is for the right brain thinker, 100 pages, 12 chapters with 62 chicken soup for the financial soul stories, okay? If you want to use your whole brain, you can read both. But you simply go to laserfund.com, click on the link below. You contribute a nominal amount towards the shipping and handling. Have some skin in the game. And I'll cover the rest of that and pay for the book, and I'll fire it out to you. But there's also options there to watch and learn, listen and learn. There's even an 18-hour masterclass, but we teach educational webinars on a regular basis. So here is to your brighter future. Claim your free copy now.